Ever wondered how countries keep track of their financial transactions with the rest of the world? The answer lies in a seemingly complex but fundamentally simple concept called the balance of payments. Imagine a giant ledger that keeps track of all financial transactions of a country with the rest of the world. This includes goods and services bought and sold, investments made, money transfers, and even loans given or taken. This comprehensive record is what we call the balance of payments. Now, break it down into simpler terms. Think of it as a checkbook. When you make a purchase, your checkbook balance decreases. When you receive money, your balance increases. The balance of payments works much the same way for a country. The transactions recorded in the balance of payments are grouped into two main categories: the current account and the capital account. The current account records transactions related to goods, services, and income, while the capital account records transactions related to investments and financial claims. A country's balance of payments gives a detailed picture of its economic interactions with the rest of the world. It reveals whether the country is a net borrower or lender, a net importer or exporter, and whether it's attracting or sending out investment capital. But what happens if a country spends more than it earns, creating a deficit in its balance of payments? In the short term, it might borrow from other countries or international institutions to cover the deficit, but in the long run, a persistent deficit could lead to economic instability. On the other hand, a surplus in the balance of payments means the country earns more than it spends. This might seem like a good thing, but a persistent surplus could also lead to economic problems, such as inflation. So the aim is to achieve a balance. Not too much deficit, not too much surplus. Just like the balance you aim for in your personal finances. In this video, we've delved into the concept of the balance of payments, breaking it down into simpler terms. We've explored its two main components, the current and capital accounts. We've also discussed what a deficit or surplus in the balance of payments could mean for a country's economy. Remember, the balance of payments is more than just a record of financial transactions. It's a reflection of a country's economic health and its relationship with the rest of the world. So next time you read about a country's balance of payments in the news, you'll know exactly what it means and the implications it could have on the global economy.